In September 2020, Barclays released a report showing the increase of option activity by the retail market. And it's true that in 2020, we started hearing a lot more about options in the media, on TV, and it's completely normal that because of this, you've had so many people actually entering the market. And that has impacted a lot the options market. And Barclays in this report show all of the different consequences in terms of options volume, in terms of volatility, and they even recommend strategies at the end of the report that have outperformed the market. Hence why I wanted to make this video so we could see together which strategies they're actually recommending in the report and try to understand what are the fundamentals behind it so we can understand why they are recommending the strategies they are recommending. Because in the end, if you manage to understand what makes a good trade or what makes a bad trade and you can analyze the market yourself, it makes you very independent. Hence why I really believe that it's worth taking the time trying to understand the fundamentals so you can do after that all of this yourself. So right off the bat, before going into the report, because we obviously not going to analyze line by line, that would be a very boring video. In this video, we're really going to try to summarize what they're saying so it's understandable and it's very relatable for everyone. So what they're basically recommending in this report is to be what we call short volatility. To fully understand what being short volatility means, we need to understand two things. We need to understand what is the implied volatility and we need to understand what is the realized volatility. So first of all, let's talk about the implied volatility. So I'm sure that if you've been, trading options or if you've been familiar at least with that field, you must have heard at some point about the implied volatility. Well, the implied volatility, see it that way. It represents the fair value of what the market expects for a certain stock. So for example, if you see that, a stock has an implied volatility of 20%, then you can expect a movement of 20% either up or down, because obviously the stock could move, either up or down. So if you see an implied volatility of 20% and the stock costs, let's say, around $100, then 20% of 100 is 20. So we can expect a movement of $20 either up or down. So we would expect the stock to go either to $120 or to $80. So that's how the implied volatility is used. It represents the fair value of what the market is expecting from the stock. And that fair value, it is priced into the option. So you're actually paying for it, meaning that if everyone thinks that tomorrow there's going to be a crash, like let's say that you know for a fact that there is going to be a crash, the put options, for example, on the SPY, they're going to be priced like super expensive, because obviously if everyone expects something to happen, then the options, they're going to be priced accordingly. Then the risk is going to be priced directly into the options. So whatever the level of the implied volatility is, you're going to basically pay for it. That's the risk premium that you're paying for. And on the other hand, the realized volatility is actually what happens after, what happens for the stock. In other words, like that's the actual movement of the stock. But what does that mean? Why am I talking about the implied volatility and realized volatility? Well, the reason why I'm talking about those two terms is that, as I said, the level of implied volatility that you have for a certain stock, if you want to, for example, buy an option, you're going to pay that risk. You're going to pay that level of implied volatility. And the higher the implied volatility is going to go, the more expensive. It's a sign that the more expensive the options are getting. So you're going to pay for that risk. But the thing is, you don't know if actually what you're paying for is actually going to happen, because if, for example, we expect an implied volatility of, let's say, 20%, taking my example of before, but you only have a movement, a realized volatility of only 10%, when the implied volatility was of 20%. Well, in that case, you bought an option that was overpriced because you paid too much compared to what actually happened. And that's the difference between implied volatility and realized volatility. And usually what is going to be shown over time, and that has been shown over several research, Tasty Trade has been doing some research on this, but plenty of other people, basically what we've been seeing on average is that options tend to be too expensive compared to what they're actually worth. They tend to be overpriced compared to what they're actually worth. And for example, it's not uncommon to see that the put options on the SPY are more expensive than the calls. But you would probably ask me, why is that? Why are some options overpriced? Why are put options on the SPY overpriced compared to, for example, the call options? Why is that happening? Well, the reason why, for example, in the case of the SPY, the put options are more expensive, they have a higher implied volatility compared to the calls, is that people are hedging their long long stock portfolio. And think about it. If you, for example, have a portfolio of, let's say, I don't know, like millions or whatever it is, and you have like all those shares in a portfolio, if you think that there is going to be a crash, or let's say that you just want to hedge yourself against a crash, in that case, if you buy, let's say, SPY puts that are going to expire in like 1 year or 2 years, then you're going to be protected against a crash. And that phenomenon of actually hedging a long stock portfolio and so having put options that are more expensive compared to the call options, it has been happening for a long time, where actually it's been happening since 1987, where after the 1987 crash, put options started getting more expensive on a regular basis, meaning that it's not uncommon since then to see the put options being more expensive because people are hedging the long stock portfolio, hence they're buying put options, hence that makes the option prices go higher. Hence why there has been the implied volatility overstating the realized volatility, meaning that the implied volatility is usually higher than the realized volatility because there is this risk premium that option buyers are paying for. And when you're an option seller, that's basically, the money that you make. And going back to that Barclays report, what they're basically showing in that report is that as much as the realized volatility has been increasing, meaning that the stocks have been more volatile in 2020, the implied volatility has also been increasing, leading to really good opportunity where options were actually overpriced compared to the movement itself, compared to the realized volatility. Hence why they recommend, like for some trade ideas, the short straddle. So the short straddle is basically selling a call and a put at the same time, and you bet that the stock price is staying within a certain range, a certain zone. But the most important part about this strategy linking to volatility is that by selling a call and a put, you're short options. So you short volatility, you short Vega. Vega being the Greek letter used for the volatility when we talk about options. And the reason why they're recommending it is that those options that we're selling when we are selling a short straddle, we believe that they're overpriced because the implied volatility is so much higher than the realized volatility. Well, we believe that by selling them, the volatility is going to go down, making us earn money through what we call a volatility contraction. So I know that it's a lot of complicated words, but don't make it too complicated. Honestly, it's more simple than we think. Like, it's just literally you pay for the implied volatility and the realized volatility is basically what happens. And what happens since 2020 is that there has been more implied volatility. Hence, option buyers, they tend to pay more money for the options, and option sellers tend to collect more money when they sell options. And what we've been seeing so far is that option sellers have had some good times since 2020 because the implied volatility was a lot higher than the realized volatility. Hence why, for example, for me, with my portfolio, it's been great to sell options because you had the volatility contracting, hence I was just making money by having that volatility contracting, which is quite cool. So that's really the goal of using this type of strategy when you, for example, sell volatility, is that because you believe that the implied volatility is higher than the realized volatility. But you probably ask me, how can I find stocks where the implied volatility is overstating that realized volatility? Is there a way to know which options are too expensive? Well, I personally use a tool myself that basically allows me to know which stocks have high implied volatility compared to the realized volatility. And let's jump into it so I can show you this. So right now I'm using the Predicting Alpha terminal, where basically you can have like plenty of good data. You can have a lot of information on, for example, the implied volatility versus the realized volatility. And what I have been taking as a stock right now, as you can see, I've been looking at the stock FCX. And what is quite interesting to see, if I just go down, is that they have a graph where you can see the difference between the implied volatility and the realized volatility. So in this example, the blue line is the realized volatility and the green line is the implied volatility. So what you can see basically is that a lot of times the implied volatility was higher than the realized volatility from, let's say, August 2020 to around January 2021, and then we can see that actually the realized volatility went above the implied volatility. So now if you're trying to sell options when the realized volatility is actually higher than the implied volatility, then it really doesn't make sense because the actual movement exceeds the level of risk that you're paying for or that you're receiving when you sell options. So it's actually not really advantageous to sell options when you have the realized volatility overstating the implied volatility. You want to, ideally, if you sell options, you want to sell overpriced options. So you want to sell options where the implied volatility is higher than the realized volatility. So you see how handy actually this type of tools can be, because now on top of, for example, knowing where is the IV rank, IV percentile, you can actually compare where is the implied volatility versus the realized volatility. So you can make more informed decisions. If you like to sell options, then try to sell options with a higher implied volatility compared to realized one. So you're actually being paid more compared to the movement that actually happened. And on the contrary, if you like to, for example, buy options, then it's better to not buy options when the implied volatility is higher. Ideally, you want to pay a fair price for the option that you're buying. So you'd want the implied volatility and the realized volatility to be around the same level, so you're paying a fair price. And another example, I just chose the stock DocuSign so as to try where is the implied volatility versus the realized volatility. And what's quite interesting to see is that you can see that over time it has been switching. Sometimes the IV was over the realized volatility and vice versa, but recently we can see that the implied volatility, the green line, is overselling the realized volatility. So now on DocuSign, for example, it could be a good moment to start selling options, as the options are priced for a bigger movement than what is actually happening. So it could actually be advantageous to start selling options on DocuSign. If you want to check out the report that I just talked about, the Barclays report, the link will be in the description. Otherwise, if you also want to check out the predicting alpha terminal, then you can also go into the description. A link will be there. And for transparency, I'm also an affiliate, so I will earn a commission if you decide to register with them. I hope you'll have enjoyed this video where I basically talked about a report. I tried to do something a bit different where I went from like a report from Barclays to try to draw some strategies from there. I thought that you find interesting. I'd love to hear your comments, so if you have any question or if you have any comments to make, I'd love to hear about it, so don't hesitate to comment it below. I'll be happy to answer any question that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.